Welcome to the Retirement Wealth Podcast. Today, we're diving into a topic that's on everyone's mind as they approach retirement: how to calculate your retirement income needs accurately.
Absolutely, Emily. It's such a crucial aspect of planning. Many people often underestimate or overestimate what they'll actually need, and that can really affect their retirement lifestyle.
Yeah, it's fascinating how many factors come into play, right? Like how long you expect to live, your healthcare costs, and even your hobbies.
Exactly. And let's not forget about inflation. It can sneak up on you. So today, we'll cover some practical steps on how to assess your needs, what tools you can use, and the common pitfalls to avoid.
And we'll also touch on how to adjust your plans as life changes. Because, retirement isn't a one-size-fits-all situation. It's very personal.
Right, and we want our listeners to feel empowered and informed so they can enjoy their retirement years without financial stress.
So let's jump right into it. First up, let's talk about how to figure out your basic living expenses in retirement.
Emily, as we dive into this topic, it's really critical to recognize why calculating retirement income needs is so urgent right now. With the current economic climate, things are changing fast.
Absolutely, David. It feels like every day there's some new headline about inflation or market fluctuations. It really impacts how people plan for their future.
Right? Just the other week, I was talking to a couple, let's call them Mark and Lisa. They're in their early 60s. And they've been planning to retire in a couple of years. But with inflation hitting the grocery store and gas stations, they're questioning their timeline.
That's tough. So they're feeling the pinch, huh?
Definitely. They had a solid plan, but with prices rising, their retirement income needs have shifted. They sat down with me, and we did some recalculations based on their expected expenses, and it turned out their original numbers were way off.
Wow, that's a wake-up call. So how did they handle that?
Well, we went through their budget line by line, and they hadn't accounted for things like healthcare costs and travel expenses, which they really want to prioritize. It's becoming more common for people to overlook those details, especially when they think about how much they want to enjoy their retirement.
Right, and healthcare costs are only going to keep rising, aren't they?
Exactly. And with potential changes to Social Security on the horizon, it's more crucial than ever to have a clear picture of what they'll need. Social Security might not cover everything, and relying solely on it can be risky.
For sure. I think a lot of people don't realize how much they'll really need in retirement. They often underestimate it, right?
Yes! I see that a lot. A common scenario I encounter is folks thinking they can live on 70 to 80% of their pre-retirement income. But when they look at the real costs, it's often closer to 100% or even more, depending on their lifestyle choices.
That makes sense. So what are some of the factors that can really throw a wrench in those calculations?
Well, market volatility is a big one. Just think about how unpredictable the markets have been recently. If someone's relying heavily on investments for income, and those investments take a hit, it can really impact their lifestyle.
It's like a roller coaster ride, isn't it? And not the fun kind.
Right? And then there's tax efficiency. People often forget that their withdrawals can trigger higher tax brackets, which means less income overall. We've seen that with retirees who had to adjust their plans on the fly because of unexpected tax bills.
That's a great point. I've heard stories of retirees being shocked by their tax bills, especially if they're pulling from multiple sources of income.
Exactly. And then there's the emotional side of it all. I had another client, let's call her Susan. She was so worried about running out of money that it was affecting her quality of life. She didn't want to stop going out to dinner or traveling, but she was so focused on the numbers that she forgot to enjoy the present.
That's heartbreaking. It's like you work hard your whole life, and then you're too anxious to enjoy it.
Yes, and that's why getting a clear understanding of your income needs is crucial. It's not just about the numbers. It's about peace of mind. If you have a solid plan, you can actually enjoy those years without that constant worry.
So true. And it's also about legacy planning. Many people want to leave something behind for their children or grandchildren, right?
Absolutely. But if they haven't calculated their needs accurately, they could end up leaving very little, or even nothing. I had a couple recently who wanted to set up a college fund for their grandkids, and they realized they hadn't factored that into their retirement income needs.
That's a big oversight. It's so important to balance enjoying your retirement with planning for the future.
Exactly. And with current economic trends, there's so much uncertainty. It really emphasizes the need for flexibility in your retirement plan.
Yeah, and being proactive can really pay off. If you can adjust now, you might avoid a lot of stress later on.
Well said. It's also about understanding the true cost of living in retirement. Many people think they'll be spending less, but with new expenses popping up, sometimes they end up spending more.
Like unexpected repairs or even just inflation eating into their savings.
Exactly. And we can't forget about the emotional side of financial security. A lot of people feel a sense of relief once they have a solid plan in place. It allows them to focus on enjoying life rather than worrying about finances.
Right. So it sounds like a lot of these factors really reinforce the idea that planning needs to be ongoing. You can't just set it and forget it.
Yes, exactly. Regularly reviewing and adjusting your plan is key, and having a professional to help guide you can make a big difference.
So now that we've laid out why it matters so much right now, what are some strategies that can help listeners accurately calculate their retirement income needs?
So, let's dive into some practical strategies for calculating your retirement income needs. A good starting point is understanding what your expenses will look like in retirement. Things like housing, healthcare, and of course, leisure activities.
Right, and it's not just about your current expenses, but also considering how they might change. For example, healthcare costs tend to rise, right?
Exactly. A common rule of thumb is to estimate that you'll need about 70 to 80% of your pre-retirement income to maintain your lifestyle, but that can vary widely depending on your individual situation.
So if someone is making, say, $100,000 a year before retirement, they might expect to need around $70,000 to $80,000 annually in retirement?
Yes, that's a solid estimate. However, it's essential to fine-tune those numbers based on your specific plans, like travel, hobbies, or even moving to a different state with a different cost of living.
And speaking of fine-tuning, how do stocks and bonds play into this calculation?
Good question. A typical strategy is to have a balanced portfolio, often a 70-30 split between stocks and bonds. This helps to provide growth while also offering some stability. Stocks can help you keep up with inflation, while bonds can provide a steady income stream.
Got it. So when you're thinking about your investment accounts like 401ks or IRAs, how do those fit in?
Well, those accounts are crucial because they offer tax advantages. With a traditional 401k or IRA, you can defer taxes until retirement, which can significantly impact your overall income needs.
And what about Roth accounts? How do they differ?
Roth accounts are funded with after-tax dollars, so while you don't get the tax deduction up front, your withdrawals in retirement are tax-free. This can be a game changer for managing your tax burden in retirement.
That's really interesting. So let's say someone has both a traditional and a Roth account. How would they decide when to withdraw from each?
That's where tax planning comes in. Ideally, you want to withdraw from your traditional accounts in years where you're in a lower tax bracket. This helps you manage your taxes over time. The Roth then becomes a great resource for years when your income might be higher.
And what about real estate? How does that factor into retirement income?
Real estate can be a fantastic part of your retirement strategy. If you own your home outright, that's one less expense. Plus, if you choose to downsize or move to a less expensive area, you can free up additional cash.
So it's not just about the property value, but also the cash flow opportunities it can create?
Exactly. And some people even consider rental properties as a way to generate income during retirement. It's about diversifying your income sources.
That makes sense. Now, what about annuities? How do they fit into this picture?
Annuities can provide guaranteed income for life, which can be reassuring, especially if you're worried about outliving your savings. However, they come with fees and complexities, so it's crucial to understand how they work before committing.
Right, it sounds like it's really about balancing different income streams. Speaking of that, let's talk about Social Security. How can someone optimize that?
Social Security can be a significant part of your income, but timing is key. The longer you wait to claim, up to age 70, the more your monthly benefits will be. For example, if your full retirement age is 66 and you wait until 70, you could increase your benefit by about 32%.
Wow, that's substantial. But what if someone needs the income sooner?
In that case, it's a trade-off. You can claim early at 62, but your benefits will be reduced. It's essential to look at your overall financial picture and consider how other income sources will support you until then.
And we can't forget about withdrawal strategies, right? Like the 4% rule.
Yes, the 4% rule is a popular guideline suggesting that you can withdraw 4% of your retirement savings each year without running out of money over a 30-year retirement. But keep in mind, this is based on historical market performance and may not be suitable for everyone.
So if you have, say, $1 million saved, you could withdraw $40,000 a year?
Exactly. But it's essential to adjust for things like market fluctuations and your specific expenses. Some people may use a bucket strategy, where they segment their investments into different buckets for short-term and long-term needs.
I like that idea. It helps to manage risk and cash flow. Can you give an example of how that might work?
Sure. You could have one bucket for immediate needs, say cash and short-term bonds, for the first few years of retirement. Then another bucket for intermediate investments, like a balanced portfolio of stocks and bonds, for needs in the next 10 to 15 years. And finally, a long-term bucket invested in stocks for growth, to be tapped into later on.
That sounds like a smart way to ensure you have enough liquidity while also growing your assets.
Absolutely. And remember, diversification is key. You don't want to be overly reliant on one asset class or income source.
Right, and it sounds like there are also tax-saving techniques to consider as well.
Yes, tax-efficient withdrawal strategies can help minimize your tax burden in retirement. For instance, consider withdrawing from taxable accounts first, then tax-deferred accounts, and finally tax-free accounts like Roth IRAs.
It's all about maximizing your resources, isn't it?
Exactly. And keeping an eye on your asset allocation as you age, you might want to shift toward more conservative investments as you get closer to retirement.
Before we wrap up this section, what are some common pitfalls people should avoid when planning their retirement income?
Well, one big pitfall is not having a clear understanding of expenses. Many underestimate how much they'll need, especially with healthcare costs. Also, failing to plan for market volatility can be risky. You want to have a strategy in place for those downturns.
Those are great points. It sounds like a solid plan, and ongoing adjustments are crucial for a successful retirement.
Absolutely, and being proactive rather than reactive can make all the difference.
Let's transition to those common pitfalls and explore how to navigate them next.
So, Emily, let's dive into some of those common pitfalls people face when calculating their retirement income needs. It's really easy to overlook certain factors that can have a big impact, right?
Absolutely, David. I think one of the biggest mistakes is underestimating the sequence of returns risk. People often assume that their investment returns will be consistent, but that's rarely the case.
Exactly. If someone retires during a market downturn, the way they withdraw money can really affect their portfolio longevity. Like, say, a couple retires in 2008, just before the financial crisis. If they started pulling from their investments right then, they could face a much shorter retirement than they planned for.
Right. That kind of timing can really mess things up. And then there's the issue of ignoring taxes when planning withdrawals. I've seen people think they can just take out a flat amount without considering how taxes will eat into that.
Yes, taxes can really take a chunk out of your withdrawals. A real-life example. I had a client who retired and started taking a significant amount from their traditional IRA, but they didn't account for the tax implications. They ended up in a higher tax bracket than they anticipated, and were shocked at how much they owed at tax time.
Oh wow, that's tough. It's so important to strategize those withdrawals. Speaking of strategy, what about healthcare costs? That's another area where people often underestimate their needs, right?
For sure. Healthcare can be one of the largest expenses in retirement. A study found that a couple at age 65 can expect to spend around $300,000 on healthcare expenses in retirement, not including long-term care.
That's a staggering number. And if people don't plan for that, it can really derail their entire financial plan. I've heard of retirees who had to dip into their savings just to cover unexpected medical bills, which is really disheartening.
Exactly. And let's not forget about longevity risk. People are living longer than ever, and that means your money has to last longer too. I had a client in their early 70s, thinking they'd be fine with their savings until they discovered that their family history included several relatives living into their 90s.
Oh, wow. That's a wake-up call. It's crucial to consider how long your money needs to last, especially if you're in good health and potentially living longer than average.
Absolutely. And then there's the issue of poor asset allocation. I've seen retirees who are still heavily invested in stocks, thinking they can ride out the market. But if they're withdrawing from those stocks during a downturn, it can lead to a significant loss of capital.
Right, because once you sell during a downturn, you're locking in those losses. Balancing your portfolio to ensure you have the right mix of growth and income is vital, especially as you age.
Yes, and another common mistake: claiming Social Security too early. Many people jump at the chance to start receiving benefits at 62, but they might not realize that waiting can significantly increase their monthly benefits.
Definitely. I read about a couple who claimed early just to get that immediate cash flow, but they didn't consider how much they were leaving on the table by not waiting until full retirement age or even later.
That's a great point. The longer you wait, the higher your benefit, which can make a huge difference over the years. It's all about understanding the long-term impact of those decisions.
And sometimes, people don't think about how their lifestyle choices can affect their retirement. Like, if someone has a habit of spending more than they should, that can lead to financial strain later.
Yes, lifestyle inflation is a sneaky one. You might think you're fine now, but if your spending increases as you approach retirement, you might find yourself in a tight spot. It's all about being honest with yourself about your spending habits.
Exactly. So, what are some red flags that people should look for early on in their retirement planning?
Well, if you notice you haven't updated your retirement plan in a few years, that's a big red flag. Life changes, market conditions change, and your plan should reflect that.
And if you're feeling anxious or uncertain about your financial future, that's also a sign to reassess your approach.
Right. Another thing is, if you're not regularly reviewing your asset allocation, or if you haven't calculated your expected expenses versus income in a while, those can lead to unexpected surprises down the road.
Great points. So if someone realizes they've made one of these common mistakes, what can they do to recover or avoid it in the future?
The first step is to get informed, and don't hesitate to seek professional advice. A financial planner can help you assess where you are and what adjustments you need to make.
That's so true. Also, creating a more flexible withdrawal strategy can help, like using a combination of accounts for withdrawals so you can manage your tax implications better.
Yes, and consider diversifying your investments and regularly reviewing your asset allocation. You want to ensure your portfolio aligns with your risk tolerance and goals as you age.
And let's not forget about building a healthcare plan. Setting aside a dedicated fund for healthcare costs can be a lifesaver.
Absolutely. And if you're nearing retirement, it might be worth considering delaying Social Security. Even just a year or two could significantly enhance your benefits.
These are all such valuable insights, David. It really emphasizes the importance of planning ahead and being proactive in retirement rather than reactive.
Definitely, Emily. With the right strategies and awareness, retirees can navigate these challenges with confidence.
So, listeners, if you're feeling uncertain about your retirement plan or have questions, don't hesitate to reach out for help. It's never too late to adjust your course.
All right, so now that we've talked about how to calculate your retirement income needs, let's get into some immediate, actionable steps you can take right now.
Absolutely. One of the first things you can do is check out retirement calculators from companies like Vanguard, Fidelity, or Schwab. They have user-friendly tools that can help you project your retirement income based on your savings, lifestyle, and expected expenses.
Right, and these calculators often allow you to input different scenarios. You can see how changes in your savings rate or investment returns might impact your retirement plans. It's super helpful to visualize those numbers.
And don't forget about SSA.gov for Social Security estimates. You can create an account and get a personalized estimate of your benefits. That's a crucial piece of your retirement income puzzle, right?
Exactly. Knowing what to expect from Social Security can really help you plan how much additional income you'll need to generate from your savings.
So once you have those estimates, what's next?
Well, I recommend running your retirement projections regularly. It doesn't have to be a huge undertaking. Just sit down, maybe quarterly, and review your portfolio.
Yeah, just a quick check-in to see if you're On track or need to make adjustments?
And if you're feeling a bit lost, using financial planning apps can simplify that process. Many of them integrate with your bank accounts and investments, giving you a real-time picture of your financial health.
That sounds super convenient. Apps can help track your spending too, which is important when you're planning for retirement.
Absolutely. And speaking of tracking, developing the habit of reviewing your portfolio is key. You don't want to be surprised by market fluctuations as you get closer to retirement.
Right, and even if you're years away, it's good to stay engaged with your investments.
Another great habit is to read up on retirement planning. There are some fantastic books out there that break down complex concepts into understandable steps.
Any recommendations?
Sure. The Total Money Makeover by Dave Ramsey is a great start for anyone wanting to get their finances in shape. And How Much Money Do I Need to Retire by Todd Tresitter provides some really practical insights.
Those sound like great picks. And podcasts can be another valuable source of information.
Exactly. There are several retirement-focused podcasts that dive deep into strategies and real-life experiences.
Like the Retirement Answer Man, which breaks down retirement planning topics into digestible episodes.
Yes, and Smart Retirement is another one that offers actionable advice. Listening to others' journeys can really inspire you to take action in your own planning.
That's so true. It's helpful to hear different perspectives, especially from people who have been in your shoes.
And remember, it's never too late to improve your plan. Even small changes can make a significant impact over time.
Totally. Whether it's adjusting your savings rate or simply educating yourself more, every step counts.
For sure. You could also consider using tax software to project your retirement tax liabilities. Understanding how taxes will impact your withdrawals is essential.
Good point. And if you're working with a financial advisor, don't hesitate to ask them for tools or resources that they recommend based on your specific situation.
Definitely. A good advisor will help tailor those tools to meet your personal needs.
So it sounds like there are quite a few tools and habits that can really help people get a clearer picture of their retirement needs.
Exactly. With these tools in your pocket, you're ready to strengthen your retirement plan. Let's recap what we've covered today. Well, Emily, as we wrap up this episode, I think it's important to highlight a few key takeaways for our listeners.
Absolutely, David. One of the big points we discussed was the importance of understanding your essential expenses. It's really the foundation of calculating how much income you'll need in retirement.
Right, and then we talked about the significance of estimating your longevity. Planning for a longer lifespan can really help ensure your savings last.
Exactly. And we also touched on the value of considering healthcare costs. They can be a real game changer in retirement planning, can't they?
Definitely. And let's not forget about the role of income sources. Diversifying your income streams can provide a safety net and peace of mind.
Yes, it's all about building a strategy that takes all these factors into account, right?
Absolutely. And when it comes to building and protecting your retirement wealth, it's really about creating a plan that aligns with your goals and lifestyle.
Well said, David. It's never too late to start thinking about these things.
For sure. And to our listeners, if you found value in today's conversation, we encourage you to like, subscribe, and maybe even drop a comment below sharing your biggest takeaway or a question you might have.
And if you know someone who's planning for or already in retirement, sharing this episode could really help them too.
That's right. Next time, we'll dive into something really relevant: how to build inflation-adjusted income streams.
It's such an important topic, especially given today's economic climate.
Looking forward to it.
Me too. Thanks for joining us today. And remember, every step you take towards planning your retirement is a step towards financial freedom.
Until next time, take care, everyone.
Bye for now.